Okay, if everybody can hear me. If you can't hear me or if there's any issues with the audio, just please let me know in the chat. That way I can try to play around with it, but from everything on my end, it looks good. So we're gonna jump into the presentation. So just wanna thank everybody for attending. This is gonna be the 2023 GTA Commercial Real Estate Market Review. I will take you through some of the aspects of what I saw in the market last year and give you some predictions of what I think is going to happen in 2024. So it'll be interesting. So what we'll cover, number one, we're going to jump into a summary of the 2023 GTA market activity. What I'm going to do is take a holistic approach over all asset classes, anywhere from apartment buildings to commercial land, residential land, as well as retail and industrial property. I will then dive a little bit deeper into two specific asset classes that mainly I deal with, and a lot of the attendees are owners of, which is the retail market activity for last year, as well as the industrial market and the activity we saw in 2023. I will also cover my predictions for 2024. I'll share with you 3 high-level predictions of what I think is going to happen this year and how can it may affect your investment decisions or give you some perspective on what I see going forward. So let's start with the overall market, right? Essentially, what we saw is a steady decline really in sales transaction volume over the last 5 years. So this chart just really outlines the total amount of sales volume, as well as shows us the red line of the number one of the individual transactions in the market. So we saw a combined sale of $21.5 million or billion dollars worth of sales transactions last year. Now, this is the lowest actually that we've seen really since the pandemic. Even pre-pandemic, we were seeing numbers higher, closer around 22, 23 billion. And this is a steep drop from a value peak of 30.7 billion we saw in 2022. As it reflects into the transactions, we also saw a decrease in the number of transactions to only around 2,062 transactions. Now that's lower, again, one of the lowest numbers that we've seen over the last 5 years, and represents about a 32% decrease from the peak of transaction volume that we saw in 2021. So just so you understand, the values peaked in 22, transaction volumes peaked in 21. On average, we're seeing roughly about 2,400, 2,500 transactions occur amongst all asset classes throughout the GTA. So that kind of gives you an idea of the volumes and types of activity that this encompasses. And again, this includes all sectors from apartments, commercial land, residential land, hotels, retail, and industrial property. So what this year has really stemmed from, or from what I've noticed a lot, is that institutional buyers have had their pencils down. And a metric that I like to track, and I like to do this on an annual basis every year, and I'll pull up the charts here for you, but is sales over 100 million. Now, the reason being for this is that what I like to do is take a look at some of the larger institutional players. How are they viewing the market? Some of the larger capital allocators, where are they putting their money to? What's their sentiment on? And typically they're buying in a larger snap bracket, typically 50 million, but in this case, I'm looking at $100 million plus of transactions and how it's turned out. So what we saw in last year is only over all asset classes, we saw 20 transactions that occurred over 100 million. That represented about $5.3 billion worth of sales volume. To give you an idea, that's roughly 20% of the total market in sales, represented a snap bracket size of over 100 million. Now, these charts here that I've presented break it down by asset classes, so you see which asset classes compared to 22 and 20 in years 2022 and 2023, which asset classes were most in favor. And then we also take a look here at the total number of sales over, really the last 6 or 7 years or so. So kind of gives you an idea. What's interesting to take from this, the largest percentage of institutional investors, interesting enough, were not domestic, but foreign institutional buyers. These are individuals such as private equity, high net worth, or billion-dollar families acquiring commercial real estate in Toronto or in the GTA specifically, as well as buying shares or buying large positions in publicly traded or equity companies. So that's what made up the lion's share. So a lot of the domestic players actually weren't participating much in the market from the statistics that we're seeing. So this overall number represents we're down about 28% from the peak in 2022 and about 50% decrease in the number of transactions from 2021. So we can see that, you know, at 2021, I think we peaked at around a little bit over 40 transactions that were over 100 million to now only seeing about half of that, right, in at 20 this year. The asset classes that led the way, and this is typical what you're going to find, is definitely between the industrial and office sector. These asset classes are typically skewed more or less towards institutional buyers just because of the size of a lot of the assets. They tend to fall into a higher tax bracket, which gets out of the reach of a lot of smaller or private capital investors. So that's why it's overrepresented. Even though office has seen the most challenge of any asset class, they still managed to get about 6 transactions complete. And there is some skew in terms of the representation of it. Some of these transactions happened earlier in the year. So just to kind of give you an idea, it takes anywhere from about 4 to 6 months really for a transaction to occur. So anything that we're seeing occurring probably got under contract 6 months prior to that. So a lot of the office ones were earlier. As we kind of trailed into towards the end of 2023, we saw less deals happen. The biggest decline, obviously, as we can see from this market, is the residential land market. They saw about 11 transactions in 2022 and only 2 transactions last year over 100. That's an 82% decline in the amount of deals. And this is obvious from the mere fact that, you know, with high interest rates, construction costs, as well as slow pre-sales, developers were not as aggressive in acquiring residential land and opted to focus more on securing their current projects and getting through those instead of adding more to the field. So this kind of gives you an idea of what we've seen going forward. So if we dive into the retail market, and I'm going to pull up the other charts here. If we dive into retail specifically, this chart covers the total market of retail that's sold in the GTA. This one here on a quarter-over-quarter basis, I just separated it to larger transactions over 10,000. But if we look on a total volume, we saw a 7% decrease in the number of, or the sales volume from 22, and that also represents about a 24% decrease in the number of transactions on a year-over-year basis. So retail on average averages about 562 transactions a year. And we only saw about 468 deals be completed last year. So we're wiping out roughly about 100 deals out of the market from retail. And what the underlying pin, and I'll share this here, is that obviously we're starting to see how interest rates affect deal volume and transaction volume, mainly on all asset classes, and how it's starting to manifest itself in the data that we're taking a look at. If we look on a quarter-over-quarter basis, we start to see low transaction volumes. We're averaging anywhere around 200 to 250 million dollars worth of transactions per quarter. What's interesting here is that, you know, in Q4 it's a bit skewed. There was 2 large transactions that were over 200 million that really drove this up towards the end of the year: the sale of Vaughan Mills as well as the sale of Pickering Town Center. Those 2 sales, if we strip them out, represented about $400 million worth of deals. That would bring us right back down to the average of what we've been seeing on the market. So on average, technically, what I like to call, we're probably in a technical transaction recession for retail specifically. This trend I've been somewhat noticing over the last 5 years. And the reason being is that many of the investors that hold a lot of these retail assets are legacy owners. They have low debt, low financing on their assets. So there's no incentive to sell their asset if they're not able to achieve their price. Many that do come to market and they don't achieve their numbers, they'll just take it off and return and wait till the cycle returns in order to do it. So there's no pressure on that end per se with it. As well as on the retail leasing side, what we're finding is that, you know, retail is the properties are full. Tenants are still doing well. Give or on an average, so there's no incentive to move an asset when you're covering your costs and you're operating fine. Many owners just tend to work together to manage the assets going forward. So what I can say on average, it's difficult to pinpoint, is that when you have such low sales volume, it's tough to really pinpoint, okay, well, where the pricing going? Have they decreased? In the eyes of most buyers, I would say they would probably pinpoint at around 15 to 20% reduction in the price or their purchasing power of what they can actually do based on the lending rates and the interest rates today. And we're just not seeing it as much relayed out in the data because vendors are unwilling to transact at those numbers, even though they may agree that it's correct. They're not willing to accept those numbers to do it, and we're somewhat at a stalemate. So that's why we see such a low volume of transactions occurring, and I anticipate that probably to continue going forward. If we take a look at the industrial market, again here, two same charts. The industrial market will take a look at all sizes of industrial product, as well as in this chart, I just tend to focus on the middle market, anywhere from 10,000 to 100,000 square feet, which typically majority of my clients operate either own assets in or participate in acquiring that area. But overall, the industrial market has been performing the best. I mean, from a historical numbers perspective, and we can see it really exploded after the pandemic, where we saw just an increased demand for industrial warehousing, manufacturing throughout the GTA. And unfortunately, we don't have enough supply to support it. So similar to the residential apartment market or the housing market, where we are constrained for supply, industrial is just as constrained as supply for that in the same context. We saw $8.3 billion worth of transactions from the industrial sector, which represents roughly, close to 40% of the entire sales volume is coming from really one asset class, which has been pushing things, and that's an 11% increase even from a record year in 2022. Now, what we did see is a slight 10% decrease in the number of transactions. So there was only 698 deals that were completed in comparison to 2022. To give you an idea, on average, last 5 years, we've been averaging about 650. So we're still significantly above the 5-year average, but down slightly from last year. What's interesting, though, is that obviously if you're catching on, is that we're getting more on an average sale per asset. Is the values are increasing more. So we're doing less transactions, but getting more money for those deals. So that shows the sentiment and the demand for that asset. Majority of what I will say is being pushed by user operators that are expanding out of their current spaces, and they needing additional footprints or needing additional warehousing or facilities, and they are pressed for limited options, and they're aggressively paying for whatever they can do to get into the space. On a quarter-over-quarter basis, we're roughly seeing about $450 million worth of sales per year, and it's trending around roughly about the same. Again, similar to Q4 for the retail, Q2 represented some larger transactions over the $100 million mark that kind of skewed the numbers here. But if we were to strip them out more or less, we are trending around the same area. So what's interesting is that interest rates don't seem to be affecting the industrial as much. Now we are starting to see the steam getting pushed out of the market a little bit anecdotally on some listings and activities that we've seen, and activities, the reduction in bids, just because buyers or user operators can only pay so much for an asset, just where their financing is. And I think we're pushing up against that threshold, even though the demand is still there for that, and they would like to pay more. If their lenders are holding them down to a higher ratio, or the interest rates are making it difficult for their cash flow to cover the property, then it's going to continue to be difficult. But I don't think the demand is slowing for it. The demand is still high, and it's difficult to say how long this will actually go. I get that question a lot, and I anticipate this asset class to probably be the most stable, that and the apartment market to really be the most stable going forward, and continue to see probably the leading all asset classes in the price appreciation for the next couple of years at least. So I want to jump into kind of what my predictions are, and I boiled it down to really three main things of what I'm looking at in the 2024 market and what could affect the market positively or negatively with it. So number one, and surprise, surprise, obviously interest rates will decrease. Now, I know you may be hearing this in the news, you may be hearing this from other realtors or other individuals, and it's not an uncommon thought to think that interest rates will decrease. But based on what the Bank of Canada has said, as they've as they've been able to get inflation under control, we can start to anticipate some rate cuts, so that they're open to looking at some point in the year. Now, they haven't said that as to when that is going to be, and that's really the caveat depending on how the numbers play out. But what this chart shows you is what the market's bets or predictions are in the market. So this is straight from the equity markets here, what they bet the interest rates are going to be over the next 24 months. I will draw your attention first here to June, where we see about a 76% chance by halfway through this year, at least a 50% basis cut on it. If to give more context, we're at 5% right now on an overnight rate, so that will bring us down to roughly about 4.5%. They're anticipating at least by the end of the year at a 72% chance that we're actually at 1.25%. So that would take us down to 3.75, which I think will do extremely well for the market. And then overall, even if we go, 18 months out or another year out from today, we'd be looking at a 1.5% reduction in the interest rates, and they're pricing that in at about 82% probability. So there's a good chance that over the next, 12, 18 months, we're going to see ourselves in a cheaper interest rate environment, is what we can say. The only thing that can change that is obviously if the change of speed of that is that if the economy gets weaker or runs into any more challenges, the Bank of Canada may be forced to reduce it even quicker than what they're anticipating. But if we see inflation go in another direction or things change, we may end up remaining higher. But my bet is at least we're going to see a 0.5 to 1% maybe by the end of the year is where it's going to be. Now, the question is ultimately, does that affect them? How much does that affect the market? How much does that allow? And any reduction in financing costs is going to open up buyers' capabilities of paying the market. We are still seeing the demand from individual investors, and the reality is if they can afford more, then they're going to continue to be active and allow themselves to purchase more. So that's kind of my thought with it going forward. My second prediction is more relating around the sales numbers. I still believe institutional investors will be sidelined, and what we will begin to see is a dramatic increase in the number of sales below 10 million. So let me break it down for you and how I looked at it. I took the approach and the thesis of taking a look at the market and saying, okay, well, if interest rates are affecting the market, how will that manifest itself in the data, and where can we look at that to take advantage of? And what I realized, or what I noticed with it, is that obviously the larger the transaction size, more financing is going to be imperative to getting that deal done. And we should start to see a lower transaction volume on sales in a larger snap bracket than we do on the ones that are cheaper in price. And essentially that's what this data and these charts are showing out. So to give you an idea, there was 439 retail transactions that were completed below 10 million last year, in comparison to only 29 that were above 10 million. So just to give you an idea, the vast majority of all the transactions, probably 95% of all deals, were done in retail specifically below $10 million. If I parse this data out even a little bit tighter, even if we go below 5, you'll start to see probably about roughly 250 to 300 transactions that were actually done below that. So the smaller what we're finding is that investors are looking at smaller deal sizes in order to get transactions done. This also translates over into the industrial side, where we saw 477 transactions that sold below 10 million in comparison to 149 above. So again, a little bit more balanced, but still, 20% of all transactions are done over 10 million. And that just happens with industrial, where the assets and the square footages and where the price per square foot numbers are today, that yes, you're going to get more deals above 10. But on average, the smaller deals are what are getting done. Now, what this means is that private capital or investors are the ones that are continuing to drive the market. It's not the big, large institutional buyers that are moving the market. It's the smaller cap investors that are pushing it. And the smaller and what is moving in this market, and I can say this from the listings and activities in our brokerage as well as the ones that I've had, the smaller deals are moving a lot faster than the larger ones, for the simple fact that a buyer has more equity capabilities to acquire a smaller asset with limited debt, They can look to refinance later when interest rates in the future change or reduce, and maybe they can look to expand. So smaller deal sizes are what's getting done. So what that means for you is, if you are a seller, is that if your asset classes fall within this below $10 million range, you can feel confident that you can still see and generate the activity and get a qualified buyer to complete it. If you are above the $10 million number, you're going to look to VTBs or additional deal terms to help get deals done or help get transactions complete in the short term. So VTBs have been helpful in the sense that you may agree to take back some money for the next 2 years or so, with the hopes that a buyer will refinance out once interest rates are changed over the next 2 years or so. So that's kind of my thought with it. If you're at a buyer, you're going to get more deals and more flexibility in negotiations on larger scale deals above 10 million, because there's less buyers that are coming to the table there. You have more flexibility to make transactions work. If you're not in that snap bracket and you're below 10 million, just be prepared to compete a bit with it, but there's still opportunities available out there in the market. But yeah, in comparison to the size ranges, that's what we're finding is a major transaction. And I anticipate this trend to continue going forward. I think that that this is what's going to really dictate the market in the future. My last prediction, really, and it's not really a prediction, but I feel that the values have essentially hit the bottom. You may have seen this chart that I've done on previous presentations, but essentially this is the investor emotional life cycle as they go through the typical investor or business cycle in a market. And what it shows here is that if you were to ask yourself, okay, well, where do you feel we are in the market today based on the sentiment out there from talking to other investors or even from yourself, or what we're hearing from the media and others, is that we're probably right at the bottom between the depression and hope stage. We're starting to see the light at the end of the tunnel with the thought that interest rates are going to decrease at some point in the near future. So many individuals feel that look, I can hold on. I believe that this is still possible and things are going to continue. And we're going to start to see a little bit of that hope. And it's starting to translate out separately in the residential market, where we're starting to see a lot more activity in bidding wars and more of that occurring. So it's just a matter of time as it plays itself out in the commercial market. But if you take a look at what has happened really over the last 24 months, in the sense that we had the highest rate hiking cycle really in the history in the last 40 years, and it wasn't able to break the market completely. Yes, we saw sales drop. Yes, we saw activities drop, and depending on certain asset classes, ones were hurt more than others. But overall, values stayed quite strong, which underpins the idea that many of the ownership, we have a very conservative investor base really within the GTA amongst a lot of the property owners, and capital and financing or debt on their properties are quite low, which doesn't put them in a space that could affect their values going forward, or put them in a space where they would be forced to sell their assets going forward. So the one thing that could change this prediction, obviously, is if we hit a severe recession. And how this essentially plays out is that if a recession hits, then businesses or retailers or industrial tenants start to struggle, arrears pile up, then that increases vacancy. Then we may see owner operators have challenges covering their operating expenses and managing their buildings, and then which could lead to more assets being put available in the market. But fortunately, we're just not seeing that right now. And even based on this process of what I'm describing, would play out over another 12 to 18 months in order for us to really see the activity, to see that this sort of a distressed owner play out. And we're just not seeing that right now in the market, unfortunately. For I know a lot of buyers on the call here are looking for distressed opportunities or looking for deals, and unfortunately, we're not seeing that as yet with it. The one thing I would look to is also individuals that bought within the last 5 years that at really low interest rates. We are seeing them come. They have to come into this new rate environment, and on the refinance, they may find trouble where they have to come up with cash calls to improve the equity because the values may have dropped, or the lending or the properties no longer carry cash flow wise the financing. So we may see some more assets get released in that sense. But those would be the only two things that I would be really looking at going forward. But overall, I think values have kind of hit their bottom, and I think it's going to be trending up or trending at least sideways going forward on things. So Just wanted to share with you this. This was kind of the idea of my presentation. What I have coming up for everyone, and at the end of last year, I put out a survey to everybody on the list and just reached out to the client base and wanted to hear what would they like to hear more from me, and what more value could I deliver to them. And the overwhelming response was that everyone was open for an in-person event, of which I've decided I put together this year, and you can anticipate this at some time in the spring. I'm calling this the Inner Circle, where what essentially I'm trying to develop here is a special group made up of private families who own commercial real estate. And our goal is really to organize premier events and with high quality speakers to help the members connect, learn, and build their stronger relationships, as well as allow the members to stay ahead of the industry trends and market developments, and then create comprehensive educational resources so that they can both benefit from it. So whether you're expanding your portfolio or you're looking at different investment strategies, it's a way in which I can enhance the service and value that I provide by keeping everybody informed. And this is the thought that what I'm developing this year. You will see details about the event, and hopefully I can see you all there coming forward, and we'll have a great speaker and give you some insight really into transitional issues of wealth, which I've got questions from a lot of my clients, as well as tax strategies and ways to really build the wealth as it relates specifically to commercial real estate. So look out for that. It's going to be interesting, and I'm excited for it for our first upcoming event. Finally, again, if you are thinking about selling or retiring in the next 5 years, then what I encourage is to let's talk. Let's have a strategy session. I can share with you some more specific data as it relates to your assets and where they're located in their particular submarkets, and how you can take advantage of what's to come in the future. So love to talk with you, and even to brainstorm any ideas or any thoughts that you may have. So open to chatting at any time. So this concludes the end of the presentation, so I hope you enjoyed it. If you have any questions, you can please reach out to me. You can send me an email or give me a call, and I look forward to connecting with you on the next one. So thanks a lot.